Part 10. Momentum Volume Profiling Strategies. Mark Weinstein once said, "You have to learn how to lose. It is more important than learning how to win." Welcome back to part 10, guys. Obviously, we're going to start part 10 with some theoretical principles, and then we're going to move on to some of our momentum strategies and show you a few characteristics around those, how they work, how you can execute them, make good money out of them, and then obviously I'm going to get to test you again in your playbook as you go and find those strategies. But let's start off, and we're going to start in part 10 with a little bit of theory. I'm going to show you firstly what a pre-open routine of a day trader would look like. Now, as you can see in front of you, this is a routine that you can apply whether you're using volume profiling or not. The important thing is that every single morning, every single day, every day you trade, you need to go through this routine and answer the questions, because by answering this question, you're extracting a lot of objective information from the market. Now, it's this very objectivity that will protect you. It will help you, understand when a certain strategy should be employed and when it shouldn't. It's going to help you to go with the trend or not go against the trend. And that's why we do this routine every single day, because it will help us to remain objective. So let's begin. Firstly, you need to ask yourself the question, when you look at any market, what is driving the market? Is it fundamental or is it technical? Now, the very simple premise is that when a market is being driven fundamentally, there is a lot of flow in the market. Technicals are far less important, so volume profiling will become far less effective. However, when the markets are technical, they're obviously it's going to be far better to employ technical type strategies. So that's the first question you ask yourself. Secondly, is there conviction in the move? By conviction, we mean, is there confidence? Is there momentum? Is there high volume? Is there belief in this move? Does the market really believe that prices should either be higher or lower? Then, is there a flight to safety? In other words, when the market is moving risk on or risk off, we get flows that are being allocated across various asset classes. So it's important to understand, is there a genuine move in the market that is occurring because of panic, because of fear, because of maybe political risk, or is it just normal, market moves that are occurring? Then, are there any strong correlations? What do we mean by this? At times, if you look over the past couple of months, with all the US Federal Reserve hiking rates, there's clear correlations now between the Fed hiking rates and the stronger dollar. So, whilst this strong correlation exists, we need to ensure that we're not going against these strong correlations. When the correlations are in play, we don't want to be using strategies that counter, these strong correlations. Now again, correlations become stronger and weaker over time. So it's important to understand when there are correlations across various asset classes. The next thing, what is the market condition? Is it trending? Are we in an early, late, or mature phase of trending? Or are we bracketing, moving sideways? What is the inventory of the market? In other words, what is the net position of the market? Are there quite a few longs in the market? Are there quite a few shorts in the market? What kind of longs in the market? Are they longer term, medium term, day traders? Or are they short term? Then, bracketing. How's the market moving? Are we at the top of the bracket? Or are we at the bottom of the bracket? How are we moving between the bracket? Where's the most volatility coming within the bracket? Now, the reason we assess the market conditions is so that we can ensure we're employing our strategies in the right context or conditions of the market. We then want to look at volume and range. What is the volume doing at that point? Is it higher, is it lower? Is it moving higher or is it lower? Is it substantially lower? Again, remember, volume is a relative term. The same thing with the range. Is the range expanding in this market or is it contracting? We then want to answer, where will all various participants, longer term influential participants, be getting involved? This is crucial. Remember, we spoke a lot about these influential participants and how they can initiate moves. So understanding where they're likely to enter is crucial for future market movements. We then go and we determine where are our ideal trade opportunities. Those trades that you look at, you say, I must take this trade. This is of key importance. It's important and imperative to remind yourself of these key trades every single day. They don't come along very often. So by reminding yourself every single day, you will be ready the day that opportunity comes. And most important, you will take advantage of the opportunity the day that comes. Then, what are some of the clues from yesterday's volume profile? What are some of the easy observations that we noted from yesterday's profile? We then have a look at some of the overnight movements. Has there been movement in Asia? Has there been movement in Europe? What are the overnight movements that we can pay attention to that can give us early clues for when our market opens? We'll then work out our opening calls and determine where the markets are going to open versus where they should open, and more important, determine if there is an opportunity. And lastly, we complete our profile metric sheet that I showed you how to do in Module 2. Here is a basic trading profile metric sheet that you would complete once you've done all the other 11 steps as discussed in the previous slide. In the next slide, what I'm going to do is I'm going to take you through each one of these steps, and I'm going to show you how I would apply them to the volume profile before the day begins or before the trading session begins. So some of the things I will discuss with you is, firstly, what is the opening call? What day type did we have on the previous day, and what kind of day type can we expect today? What type of open can we expect? Then, are the markets bracketing or trending? What is the value area location, and what does the value area from the previous day look like? Any control factors in the market like tails, gaps, low volume nodes and high volume nodes? And what are some of the anomalies that could potentially be filled out? I would then develop a hypothesis both in a neutral, bullish and bearish case based on the information provided. This is a very, very basic summary or very basic template that I would complete every single morning before my market opens so that I'm prepared, fully prepared to take on the markets. In the next slide, I'm going to show you an example now of how I apply this template to the marketplace. Welcome to this volume profile trading routine example. The example we're going to talk about, and the example you can see in front of you, is the German Bund 10-year. Now what we're going to do is I'm going to take you through a very basic example of what a typical day trader profile routine would be. Now the first thing you would want to establish when getting in the morning is what is the opening call of your market, whether that is a European market or a US market. Now the way in which we would do that is we would look at the overnight market. So if we were trading a European session, we would have a look how the Asian market responded. If we were trading the US session, we would look how the US markets have traded, and if we were trading the Asian session, we would look how the US markets traded. Now, in determining the opening call, some of the key factors you would require is 1, where did the market close on the previous session, and then 2, how did the overnight markets move. Now, based on this opening call, we can then move towards various trade strategies if the market doesn't open where it should. We would then move on and try and observe what the previous day type was. Now, looking at the example provided, we can see that the market had a relatively, sort of almost like a little bit of a trend type day where the market opened and it drove higher, quite a bit of aggressive initiative before forming a distribution. Now, this day type is very indicative of some sort of a potential continuation type pattern on day 2. So by having a look at this, the previous day type, we can then obviously start to formulate a hypothesis for the current day. In terms of our open type, we would then have a look at how the current session has opened in the markets. Now, as you can see, that would be both the K and the L time frame. Now, as you can see in this example, the market opens, it tests a little bit lower, almost like an open test, and then it drives higher out of the previous day's value area depicted between the orange lines. Now, this open type is particularly important to interpret and write down, as this is again going to add value to our hypothesis 1 once the cash markets open. We then move on and talk about our, let's write the over test drive. Open test drive, there we go. We then move on and we determine whether the markets are bracketing or trending. Now, in the example on the left, or the chart on the left, we will look at how the market is traded in the previous sessions. Now, as you can see, for a number of days the market sort of sat sideways in a bracket type formation. We then had a little bit of trend in the market, a little bit of initiative. We can see obviously quite an aggressive move there and another aggressive move there. The market then again settled into a bracketing type formation. So we can see that the market has sort of formed one big distribution, then shown initiative and formed another distribution, leaving in between a low volume area. So again, by identifying, are we either bracketing or trending, we can start to sort of establish a bigger time frame type confluence profile. We then move on and we have a look at the value area location and where we are trading relative to that value area. So as you can see, based on the previous day's value area, the market opened firmly in balance. So we opened initially in balance and the market instantly drove outside of balance. So already in the very early trade, we can see the market trying to move away and find value elsewhere. Now note, we can also talk about, the size of the previous day's value area and where it had occurred, in the bigger picture. We then go and highlight some of the key control factors that can be found, maybe not just in the previous day, but over the previous sessions. As you can see, based on the previous day, we have relatively, large, sort of K-tail. We then also have a large amount of sort of single prints in the market and untraded low volume areas. And then obviously we have a nice high volume area towards the high of the day. These sort of control factors being tails, gaps, low volume nodes and high volume nodes, we can also go and find in a number of periods before the current day type that we are looking at. What we will then do is go and establish all the various anomalies that can be found in the previous session. Now the reason we do this is because a lot of the time the markets like to fill out and complete these anomalies. As you can see, then some of the anomalies from the previous day would be, again, potentially, any kind of high volume or low volume, highs and lows, potential ledges, bad highs, and then the location of the volume point of control. As we can see, the market initially opened and drove up higher towards the previous day's high. And in terms of the current day's profile, we don't have too many anomalies other than the very aggressive low volume areas. What we would then typically do is we would then typically look for any kind of anomalies in the previous couple of sessions that the market might want to complete. As you can see in the larger of the two charts, we have an untraded or a naked VPOC. And this is just a VPOC that hasn't been traded over a period of time. In other words, a high volume area that wasn't retested. Again, we can also see some high volume nodes there that weren't retested, as well as a whole host of other potential anomalies in the previous days. What we would then look to do is we would then look to go and formulate a daily hypothesis and try and establish a neutral, bullish or bearish type trade strategy. Now, based on the current day's profile, we would look with all the objective information provided in points 1 to 7, we could look to establish some sort of a trade setup whereby if the market opens and holds, in other words, the cash market opens and holds above the previous day's value area high, we'd look for an early retest of the previous day session's high. This would be a very bullish hypothesis number 1. If, however, the market failed to hold that break above the previous day's value area and came back inside the value area, as we can see it did, we would then turn far more neutral on the day type. We would also then look if the market then took out the previous day's value area low and continued to hold below their previous day's value area low. There's a high likelihood we have some positioning in the market from the long side, as well as a substantial low volume area that requires filling out, and this would be our bearish hypothesis on the day. This is now how you would basically complete, or this would be a basic trading profile routine that traders would do every single morning, both ahead of the market open and ahead of the cash open. Now don't forget, it's important that you go and establish your own routine. Try and identify the key factors that will add value to your trading before the session begins. Good luck. We spoke back in Module 1 all about edge and how to develop that edge and how important things like process, routine, discipline and patience were. I hope now after that previous slide you can start to understand why it's so important to have such a structured process and routine in place. Having this routine will allow you to have always, first and foremost, an objective understanding of exactly what the market is telling you. Now, before we move on to our strategies, our momentum strategies in part 10, let's talk very briefly about the cash hours. So, the cash, or also as it's known as the pit open, brings a hive of activity as long-term participants look to execute whilst and when the liquidity is high. This means we have a higher volume within the first hour of trade as well as the last hour of trade than at any other point during the trading session. Sometimes the higher volume is accompanied by extreme price movements. The important point to remember is when there is volatility and price response, it means opportunity exists. It's this opportunity we will look to explore with two high probability or three high probability momentum strategies going forward. Now, the important thing to understand is that when the markets officially open and the cash officially opens, this is prime time for big influential players to come into the market and execute the business that is required. What you have to learn to do is differentiate between when that business is likely to move the markets aggressively in one direction or when it's likely to be met by a counter large position. Knowing the difference will stand you in good stead to making extremely good strategy momentum plays early on in your trading day. Let's now have a look at some momentum strategies we're going to develop. So part 10 has got 4 unique trade strategies that we are going to discuss one by one, a lot like what we did in part 9. Let's first define what momentum means. Now, first and foremost, we look at the time frame players involved. When it comes to momentum strategies, we are most likely to see quite an array of time frame participants, from the algorithms to the day traders to the short-term traders, even the swing traders, as well as potentially some initiative time frame players. So as you can see with momentum players, there tends to be a whole host of players that enter the market. Now, what we have to try and understand is whether or not momentum plays are either driven by initiative or by responsive. What do we mean by that? If there's an initiative play coming into the market or that creates a momentum play, this kind of momentum is the type that we particularly want to pay attention to, because this is the kind of momentum that is unlikely to be countered and will give us maximum output. If, on the other hand, it's responsive type players that are effectively creating a momentum, this is not always necessarily the best opportunity. Why? Because responsive means that, for instance, as prices are moving higher, what's happening is it's actually shorts that are covering their positions that is taking price higher. So this is far more short-lived momentum than what it would be in the case of initiative price response. In terms of the objective or time objective, time is crucial when it comes to momentum strategies. Momentum is exactly that. It's speed and velocity. Therefore, by definition, we shouldn't be spending much time, at the price that we enter the market. So time is a crucial element when it comes to developing your momentum strategies. In terms of volume and volatility, by its definition, we expect to see a pickup in both volume and volatility. So what should occur is that as we trade various prices and the momentum picks up, we should see the volume increasing and we should see the price range, or at least the volatility within the day, pick up as well. Again, if we do not see this, these are early indicators that maybe the momentum is not as strong as suggested. In terms of risk reward, well, this is one of the categories of strategies that gives almost maximum risk reward. And the reason being is because we enter with very, very tight stops. Now, what do I mean by that? Remember, as we spoke in previous slides, I said a stop is placed where the trade idea is no longer valid. In this instance, momentum is exactly that. The minute the momentum disappears and the market cannot go in the direction of the momentum, we exit the trade. We do not wait. If the market does not move in a momentum response like we expect it to, we merely exit. By having such a tight stop and having almost an open-ended target, this will allow us to take maximum risk-reward opportunity plays. And then momentum. Again, we expect to see a momentum price. Now, what that means is that we shouldn't really see prices, sitting constant and static for very long. So we want to see a momentum. We want to see sort of almost a flow within the price response as we take out key points and as we enter our key momentum strategies. So these are some of the definitions that you would need to define for your momentum-based strategies. So here are some of the momentum strategies we are going to be discussing in the slides ahead. Firstly, we're going to talk about the open drive. Then we're going to talk about the confluence initial balance breakout. We're then going to move on to the consolidation breakout and finish with a wide initial balance distribution. Each one of these strategies has unique characteristics and unique opportunity. The important thing is that you are able to not only understand these strategies, but more importantly, find them in the markets and then hopefully add them to your arsenal of trading strategies. Let's get into it then, and let's start off with the open drive. Welcome to Strategy 3, the first in a series of the momentum trade strategies. Quite possibly my favorite strategy that I've developed, and it's called the open drive. So I've named it the open drive because one, it comes traditionally at the open of a market, and two, it drives and it shows real initiative and intent. And if you're well prepared early on in the session and you're awake and switched on, you can really start your day off to a real good start. And that's why I love the open drive. So let's go through this strategy. I'm going to show you the basic characteristics, the rules, preconditions, how you execute, and some of the things you can expect to see when developing this trade. Now, the imperative thing to understand is, what do we mean by open? Now, what I want to illustrate is there's no exact correct time frame for open, but what I've found traditionally is it tends to be at the beginning of where there's a surge of volume and volatility. Now, the open drive varies across different markets, and I'm going to show you some examples. So the Bund, for instance, would typically do an open drive between 7 and 8 a.m. So we will see an example in a bit, and I will show you what a traditional Bund open drive looks like. In terms of the E-mini S&Ps, this would traditionally come at 2:30 once the cash put session begins. We would then have a look at the oil, and again, there's no exact time for this, but this can come from, potentially in the European session from around 8 a.m. or even in the afternoon session from around 2 p.m. And lastly, the Euro-dollar FX, again, there's no exact time, but traditionally I found this begins somewhere around 8 a.m. when the European markets come into play. Now, the important thing to understand is not necessarily, the exact time. There's no trade strategy is ever exact. What is exact is the characteristics and the principles I'm going to show you about the trade strategy. So when you see those characteristics, you can execute them, and over time, you will start to notice when this open drive occurs and at which time in the various markets. Now, let's get straight into it and talk about the characteristics. So, as you can see in the example of the E-mini S&P, this started at around 2:30 p.m. in the afternoon. Now, what I want to illustrate is the initiative. The initiative is the most important aspect of this trade strategy. And you can see that very early on, the market has shown this initiative, and we've opened up with a K print and an L print and an M print and an N print, and we've moved from 21.14 all the way to 21.36 very early on. Now, that is the single early or biggest clue of the open drive, which is we see the initiative very early early on, that initiative tends to be very volatile. We tend to see a lot of volume. And lastly, the range of the open drive tends to almost be 100% of the current daily moving average. So that's the important thing to understand. We do a relatively large range with a lot of volume in a very short space of time, early on in the session. And those are the basic key, fundamentals and characteristics of the open drive. Now, in terms of the reasoning behind why this occurs and why it tends to occur at the beginning of a session is because there is new business that needs to be done. And that's imperative to understanding, this strategy. In other words, someone or a big institution has received an order and they need to execute that order at best price possible. Now, there may be a number of institutions doing the same trade, but the logic is that the market will keep moving until that large order can find some responsive sellers in this example and hopefully get that or utilize that liquidity to fill out the order. The problem that tends to occur, however, is when there isn't sufficient liquidity in the market, we then tend to see the continuation of the open drive play over the course of the day. So that's the key. When you see an open drive, it's important to understand that this can, potentially be the beginning of a trend day, but also more importantly, the initiative tends to hold throughout the current session. Now, imperative to point out, when we talk about preconditions and rules, the opening price is an absolute line in the sand. We should at no point, one, be getting close to that opening price, or two, taking it out. If we do, however, that is showing us that the initiative is not only lost, but also any kind of long positioning from the open could be washed out, and we sometimes do see some very aggressive reversals in the opposite direction. So keep that in the back of your mind whilst developing this trade strategy. Now, in terms of execution, so where does the actual strategy come into play and how can we take advantage of it? So the simple answer is that if you do miss this first initiative, okay, it's not easy to get onto that initial initiative because more often than not, you're probably buying it quite high up. There's probably a little bit of disbelief in what you're seeing. You may even be on the opposite side thinking, well, this is a good area to potentially sell. So a lot of the time, we do miss this early initiative. That is okay because that is not where the highest probability opportunity is. The highest probability opportunity exists on the first pullback. That is the key to developing this strategy, and that is the key to making money out of the open drive. So what I would typically look for is I would measure the length of that initial move, and I would be looking somewhere around the 38.2%. I would be looking for an initiative buyer to re-enter the market. So note what I've said. I don't passively enter the market at 38.2. I allow the market to pull back, and the minute I see any sort of a reloading or a buyer, becoming a little more intentional on that pullback, I then execute very aggressively at market, looking for at least a retest of the previous, or the high of the day, but as well as the extension. In terms of risk, well, once you see that buyer entering, again, you want to measure what is the potential opportunity that you are going to receive. But to make sure I execute this trade well and stay in it with the correct stop, I always position my stop around the 50% of the day. The reason behind this is that I know if I'm getting in roughly somewhere around the 38.2%, that's giving me roughly a 20 or 12%, stop versus the potential for 38% of the move reward. So by that very definition, I am taking on a very good risk-reward strategy, and more importantly, I'm utilizing the objective information the market's giving me and sticking with the short-term trend. So that is the basic premise of how the open drive works. Now, what I'd like to do is, I just want to show you another example of an open drive that we typically see in the German Bund. So this example is starts or comes from 7 to 8 a.m. So as you can see by the chart, again, notice a very wide initial balance, notice the lack of overlap and a really large K-tail, and then once the cash comes in with this imprint, notice how quickly we extend upon the initial range of the day. The market then moves sideways, has a little pullback before we then extend, pullback, extend, pullback, and extend. Now this example is slightly different to the previous as the pullback isn't as deep. So again, note what I said, I'm looking somewhere around the 38.2, but more importantly, the minute I see that buyer, I want to step in and look for longs, looking for the extension to the upside. Again, notice how in this example, had we sort of tried to move our stop up or try to manage this trade instead of sticking to our original 50% of the trade, we would have potentially actually not taken advantage of the continued move to the upside. Also note the difference in this trade, how whilst it did move higher over the rest of the day, it did actually take a little bit longer than the first example. So do bear this in mind when you look at your various open drive strategies. Make sure you take into account the time factor. Make sure you take into account, are you going to trail a stop? All right? Take into account all these different variations when developing the open drive for yourself. The important thing to understand, and the most important, is that when we have a traditional open drive, the market holds that initiative throughout the period of the session. Let's now go into our replay functionality, and I can show you, with the live market, how you can execute and get and help you manage to get the timing, perfected on the open drive strategy. Welcome to the replay series, and we're back for strategy 3, the open drive, which is the first of the strategies within our momentum strategy series. Now, this is quite easily my favorite of the strategies that you find, and there's a number of reasons. I think the most important that when we see the open drive, no matter which market it comes in, it tends to give us opportunity throughout the course of the day. And the reason is because an open drive, by definition, is an initiative play. It's a momentum play that the market's showing us. Now, just a few things to bear in mind before we actually get into the replay. The context. Where do you find this, this open drive? Where does it likely occur? Well, first and foremost, the open drive exists in every single market. Now, if you look a little bit about the history of the open drive, it's nothing more than, where participants, they're fresh out from, from the night, and they've had a lot of time to assess strategies, assess various risk, and they've come in with a sort of a preconceived plan. They've really thought about what they want to execute, how they want to execute, but most importantly, they want to do it off the gun. They want to, as soon as that market opens, they want to initiate. Whether that's because they fear they may miss out, whether it's for fear that there may be other participants doing the trade, that is irrelevant. What's relevant is that it happens straight away as soon as the markets open. Now, this play does occur, as I said, it occurs both in the bonds. This will typically be, if you're looking at the German bonds or the European bonds, that'll occur either 7 a.m. or 8 a.m. If you're looking at the U.S. equities, the S&P or the Dow or the Nasdaq, this will tend to occur around about the cash open. The oil will be the same at the pit open, and the Euro-dollar FX will tend to occur around about the European cash open. So this play exists in a number of markets, and as I showed you the two examples, both the E-mini S&P and the one you've got in front of you, which is the German Bund, this play is really fantastic. Make sure you spend a lot of time finding the setup and implementing into your playbook. Now, let's just talk about where you can likely find it. Now, some of the places I've always tended to find this is that sometimes when a market opens around key support and resistance, so maybe the day before the market's traded or advertised various prices where bigger bigger, more influential players feel that this is a good area to get involved, whether it's by support and resistance. Then in terms of the same with trend lines, so a lot of the time maybe a market, it closes the day, it looks very aggressive, where it almost feels like it's the end game and we're about to see huge trend lines being taken out. The next day you find this open drive happen straight from the open. Then also when we have really big yield levels in the market, particularly for the bond markets, and also when we have huge risk events out of the way. Now, this is something we've started to see a lot over the recent years, is whereby the market opens either a lot higher or a lot lower because there's new fundamentals, or a risk event is out of the way, like an election, and all of a sudden we see an open drive in the opposite direction. Again, note, what's important is not necessarily the reason that creates the open drive, but rather the open drive itself. Okay, when you see an open drive, you need to, if there is a big fundamental, you need to almost ignore that fundamental and just pay attention to the objectivity that the market is showing you, which is that there is very aggressive initiative from the open. Now, let's get into the setup and see how it plays out over the course of the day. So, as I said, we've got the German Bund here as our example, and as you can see, the market opened at 7 a.m. and straight away from the beginning we've seen quite an aggressive start, and the market's opened up and we've seen the market open, the K print nice and aggressive to the upside, and the very next print, note the lack of overlap between the K and the L. So very shallow pullback on the second candle of the day, or the second half hour TPO. And again, note once the cash opens in and around that M print, notice how the market again, very shallow pullback, but also a series of higher lows and higher highs. So we can see this initiative already taken from the gun at 7 a.m. and then again once the cash market comes in. Now, the first thing to understand, I'm just going to pause this for a second so we can discuss it. Now, the first play that you want to be looking for when there is an open drive is, firstly, you need to acknowledge the open drive. Okay, now, what I will say with the open drive is that a lot of traders tend to struggle with this play because it tends to come quite early on. It's one of those plays that it doesn't give you a great amount of time to think about what's happening. It doesn't give you a great amount of time to get involved, and that very aggressive start to the day tends to make traders panic a little bit. It tends to make them lose a little bit of focus and sight as to what's actually happening. So the first play is to identify. So straight away, number one, identify the open drive. Okay, now what I will say is time is a key factor here in identifying the open drive, because it's likely this will occur within the first hour or two. So within the first 1 hour or 2 hours, you will see the open drive. You will see the initiative. So that is why a lot of our traders and most trading floors are very, very switched on and alert as soon as the market opens. Okay, so the first thing is identify the open drive. Now, once you've identified the open drive, you need to execute. Now, the first execution on open drive is very simple. The way I would do it is I'm looking for a 38.2% retracement, or any sort of retracement that the market gives me an entry point. Okay. Now, the reason I tend to use a 38.2% is because it's very mathematical, it's very relative, and therefore I can actually go and work out, in terms of risk reward, how often this is going to work relative to what it's going to cost me. So there's different ways to do this. Some traders would enter, once, for instance, as you can see in this example, once we leave the set of single prints, some traders would enter. Okay. For me, I tend to use a passive entry at the 38.2. Now, in terms of a stop, well, very simply, as you can see, we have the K and the L print. For me, I would put a stop just in below that L print. Why? Because if we were to get below that L print, it's telling me that the early initiative taken is not as strong as I have perceived. So straight away, guys, these are the two key characteristics of the open drive. One, initiative. How strong is that initiative being taken? Okay, the stronger the initiative, the more aggressive the play, and the more likely it is we're going to very aggressively extend with the short-term trend. And two, okay, the second is how deep does the market pull back? In other words, if this market had pulled back all the way down, say towards the lower bound, right, what is it telling you about this open drive? What is it telling you about the strength of the buyers? All right, so those are the two key elements you want to pay attention to the early open drive. Now, do bear in mind, guys, time is a very important factor in this trade setup. So I'm just going to write down here time. Now, what time means for us in this open drive is that, let's say, for instance, this market, the K and L prints come in. Let's say, for instance, the M and the N and the next and the P and then maybe the Q. So suddenly the market started forming a whole number of prints at the high of the day. Now, it's not to say that this play has failed. It's not to say the trade opportunity no longer exists. But the longer it takes for the initiative to continue, the weaker the initiative is. Let me repeat that. So the longer or the more time it takes for the market to show the initiative or the continuation of the initiative, the weaker the initiative is. And that weakness is not necessarily that buyers aren't strong. It just means that buyers' initiative is being met with responsive sell-side action. Remember, if there are sellers selling and we're wanting prices to go higher, they won't go high. They'll only go high so long as the sellers are not responding to higher prices. So that is how we use time in this trade setup. Now, let's play this through, and I'm going to go through some of the characteristics and the execution style with you. So, note, we were looking for entry point in and around that 160 area, just above that 160 area. Note again how we spoke about, we're looking for time in terms of the extension. So as you can see here, the market, the cash opened, very quickly took out the initial balance high, and we can see now the market is starting to spend a little bit of time distributing above the initial balance. Okay, so again, note what we said here. We got 4 TPOs, so almost 2 hours of trade, that was distributing, telling us that maybe the initiative was not as strong as expected. And as a result, note how the Q print came back and actually gave us a relatively nice pullback opportunity. Now again, remember, when you have an open drive, you're looking to constantly initiate in the direction of the short-term trend. So the minute you see an open drive, you need to write somewhere on your trade paper, somewhere down there, you need to write, I do not want to be going counter trend today. Okay, when you see an open drive, that is a day type you do not want to fade. You only want to be looking for momentum type plays. Okay, so first, straight away, we can identify the market's got a whole bunch of single prints there. Again, we saw the Q print try and come in and fill those single prints and failed. Now remember, we said single prints indicate to us initiative. They indicate to us almost failure to hold or to manage to fill in the anomaly. Now, as we can see, the market's trying to come in again on the T print, trying to fill in those single prints, again failing. Okay, so what we're looking for now is whether or not, if these single prints get filled, whether or not or how low the market wants to move. Now, what we're looking for again is any buy-side opportunity so long as the open drive tail holds. Now again, don't forget also, we said the key point within an open drive is the opening price. We should not be taking out the opening price. If we take out the opening price, remember, we have an opportunity to the downside as a flood of stops are likely to be triggered. Again, also, don't forget, the more we eat into this tail, the more we can, prices drift down into this open tail, the less initiative or the less amount of strength that is being shown about the buys. So what we can see here is notice how not only is the market holding on to its tail, but it's also now holding on to the single prints and, more importantly, forming a higher distribution. So what you can see is that if we're sitting in and around buying the Q prints, buying the U prints, buying the T prints, buying the X prints, okay, now potentially also buying in and around these Y prints, notice how the market is not punishing you for being long. In essence, it's actually rewarding you every single time for going long. It's rewarding you with potential upside. And that's the clue. That's why we watch back this strategy, because you can very clearly see if you were a buyer on this day type, it's been a relatively easy day for you. It doesn't matter, you might have even executed badly, might have executed somewhere around this area, but how much risk have you taken executing at that area versus how much potential you could have made executing at that area? So the important thing to understand is execution is important. But the principle, first and foremost, is the most important thing. Because if we get the principle right, we can then afford to spend time developing or getting better at that execution. So note again, note how the Y print, the single prints have now filled, but note how quickly the market again rejected and navigated away from that area, protecting the buying tail and the open drive. And then again, note the extension of the B print. So that's pretty much our open drive, guys. It's a very, very simple but highly effective trade strategy. And it's effective because, one, we get the early initiative. Now, all I want to finish off by talking about is, in terms of the management of this trade, this is a key thing to talk about. A lot of traders tend to panic with the management. They tend to, almost execute too aggressively and lose their heads. And the reason is that what we see on the initial drive is a really big move. The market moves, say, 40 prices in a straight line. Now, traders are not used to seeing 40 ticks in a straight line. So when it occurs very quickly, traders tend to have this little bit of a fear that they've maybe missed out on something. They've missed out on the only potential opportunity of the day. And all of a sudden, instead of noticing and objectively looking at the market, they suddenly say to themselves, well, this has gone too fast, let me start selling. And then all of a sudden the market goes higher, and what do? They're still selling, and they're still selling. And the problem is that the market it's not punishing shorts aggressively, but it's not paying shorts easily. So a trader can manage to sit shorting the whole day without objectively looking at the market, which is telling them, actually, the easy money is to be a buyer today, not to be a seller. So that's the important thing with regards to this trade, is do not panic. Don't, if you manage this trade, do not panic into the trade. Why? Because notice the M print, the cash opens, it gives you a chance. Notice the Q print, it gives you a chance. The U print, the Y print, the Z print. The market has given you 5 individual opportunities in this one market throughout the period of the day. You didn't have to sell this market once today to be successful. That is the key to the setup. That is the key to the open drive. Don't forget, the open drive exists in any market. That can be not just, futures markets. You can find the open drive in equities markets, because the basic understanding is that initiative is taken early on. That concludes then our strategy 3, the open drive. My personal favorite strategy. Spend some time developing and finding the strategy, not just in the bonds, not just in the equities. Look for it in the currencies, look for it in the oil and the gold. You will find the strategy exists everywhere. Remember, guys, the more you work at this, the more time you spend finding these strategies, the better you'll become, not just at understanding and interpreting them, but also executing them. After all, guys, practice makes perfect. What I want to start off by talking about with this strategy is the concept of momentum strategies. Now, the important thing you must remember is that, momentum strategies can sometimes be relatively obvious. So with that in mind, if it's an obvious, trade strategy, you have to be, very, very smart when developing, the various characteristics and preconditions in order for you to execute. Now, the reason you need to be very smart is because momentum strategies bring with them almost an element of perfect risk-reward. So what do I mean by that? Well, with momentum strategies, by definition, if we are entering on what we perceive as momentum, the risk is relatively small. We can define that risk as the moment a market no longer shows the characteristic of momentum, we merely exit. So by having very, very small downside with almost open, unlimited type of upside, this trade strategy is very favorable, not just amongst day traders, but amongst algorithms and many other participants. So with that in mind, it's imperative that, when you develop these characteristics and rules and preconditions, you are very specific as to what you want to execute based on your interpretation and understanding. So with that in mind, let's get into the next of our momentum type strategies, which is the initial balance breakout, where we have a confluence in the market. Now, I really love this idea of confluence, and I'm going to explain to you what I mean by confluence. Well, confluence is nothing other than where we have multiple reference points that align with one another. So what do I mean by that? Let's say we have a weekly high, and we also have a daily high, and now we have a 60-minute high. So we have we're trading at a price of the weekly high, a daily high, and a 60-minute high. And all three of these happen to align at the exact same price. Now, all of a sudden, we have an area of confluence where a number of participants are looking at the same area for varying reasons. So some might be looking at it, that we may get a little bit of longer-term influential players stepping in once we break out the weekly high. We may have the short-term algorithms looking to play for a breakout once we take out the 60-minute high. And we may have some day traders or swing traders looking to initiate long trades on the break of the daily high. So all three of these different levels bring in all the various time frame participants. As a result, these confluence levels tend to be wonderful trigger points or very important reference points. Now, make sure when you define, once you obviously understand confluence, make sure you then understand, the definition of a reference point. Now, a reference point is very important in a sense that a point or a price in the market only becomes a reference point if there is some sort of influence or influential player that is willing to step in beyond that point. So let's take an example. Let's say the market has left a high and rotated off low, and this has remained the high for, say, 2016. So it's the all-time high, it's the high of 2016. We've got an important reference point. Now, once we return to this, resistance reference point, the market, or there will be a lot of participants paying attention to this point. They won't necessarily be looking for shorts, but they will be paying attention to see what the response is at this reference point, whether maybe we find a seller step in, or maybe we find momentum strategies who buy through it. So it's imperative to understand when developing not just this strategy, but any strategies to determine both confluence and reference points and the importance as to why we want these confluence type plays where we have multiple reference points. So with that in mind, let's talk about a confluence play, which is strategy 4. So how it works very simply. We have the previous day's high. And what we found is, the market opens up, whether it's, the E-mini S&P's overnight session or whether it's the oil's overnight session. What we find is that the market has an initial range inside the previous day's range. But more important, we get an overlap of the previous, day's high or previous week's high with the current day's high. What then happens is once the cash market comes in, we then see an initiative move for a break of the confluence reference point. And it's that break of the confluence reference point that brings with it momentum. Now, note, we've defined the very basic characteristics of this trade setup. We're looking for an initial range to be overlapping or to have an overlapping confluence reference point with the previous day, or even, as in this example provided, the previous week or even month. So when you see this trade strategy, the preconditions are very, very easy to determine. Now, the rules are simple. We are looking for momentum upon the break of that reference point. We expect to see the following on the break. We want to see 1, volume. We want to see 2, volatility. We want to see 3, momentum plus initiative. So we want to see a shift, as we take out in this example, we want to see a shift from maybe two-way trade to very one-directional buy-side trade only. Now, what is essential with any momentum strategies, and particularly this strategy, is that we need to see quite a lot of speed, okay? It's important when we break these confluence points, we do actually see the bigger time frame participants actually execute. Now, what we're going to do is we're going to go through 1 or 2 examples, and I'm going to show you the execution style. Now, in this example, you can see on the weekly chart, this is a weekly E-mini S&P, we can see the market takes out the 2182 confluence, which is also the sort of the initial range on the weekly, and we then not just continue up or not just sort of leave a lower volume area, but we then continue before distributing a lot higher up. Let's zoom into what a daily example would look like. Again, note, I show you the example on the weekly more because I want you to be able to understand that these trade strategies exist not just on a day time frame, but across weekly, monthly, or any time frame for that matter. So again, note how the market spends time below that reference point. It then exits the reference point, comes back, retests before we see a nice initiative move. Now let's take a look and talk about execution on the next slide. So how we would look to execute this trade is very simple. We are looking for short side trades below the key confluence point. Note, previous day's low plus current initial balance. Now once the market takes out that initial balance, as it does in this example, we are looking for aggressive entry short side trades. Why? Because every other, there will be a lot of other algorithms, day traders, swing traders, and initiative traders doing the same thing. So we look for that aggressive short, and we stay short the market so long as we do not re-enter or rediscover that initial confluence reference point. Now, so long as we can hold that break point, the market should continue to drift lower over the period. In terms of exiting and taking profit, we only get out when we see other time frame participants stepping in. In this example, that would be some responsive buy-side price action. Now, an example I've shown you, we can see that it was almost instantaneous that this trade got rejected. And the reason I've used this example is because I want you to understand, whilst this is a particularly strong trade strategy, it does fail. But you have to ultimately manage the risk when it does fail. And that is why once we do enter our shorts for the momentum and continuation, we merely put our stop just above the area where the break occurred or the volume and volatility picked up. By doing that, we are allowing ourselves very, very tight risk, but open-ended opportunity. So again, I hope you've understood now how a momentum strategy is not a difficult strategy to understand. But executing it with very strong characteristics and preconditions, that is difficult to manage, because a lot of strategies are just about executing based on any high or any low, and over time those may be effective, but it's far better to develop unique, specific momentum strategies that you can then continue to develop and continue to profit off. This then concludes our strategy 4 analysis. Let's go now and look at the replay functionality of how you would execute the strategy, as well as some of the characteristics you can expect to find. Welcome back now to the replay series for the 4th of our 11 unique strategies, where we're going to talk about the confluence initial balance breakout. Now, before we move on to the actual trade setup and get going with the setup, let's just discuss what we mean by confluence. So confluence is nothing more than when we have overlapping reference points. Now, the important thing to understand about a reference point is that a reference point is not a level. It's not an area in a market whereby longer term players or short term players will initiate. A reference point is the point in the market which we reference in order to execute various positions. So, take for example, we're nearing a double top in the yield markets or the bond markets, and we can see over the course of the year this market keeps respecting. So this is a reference point whereby buyers are reluctant to buy higher prices and they back off and therefore sell out, and sellers are willing to initiate shorts. Why? Because there's a lack of commitment. So buyers and sellers both reference this point in the market as a very interesting point to focus on. Now, once we take out that reference point, we will then begin to see various different time frame participants being brought into the market, being forced to respond to the change in prices. Now, when we have an overlap of these reference points, we want to pay particular attention, and there's a number of reasons why. First and foremost, remember what I said. A reference point is the point in the market whereby it brings various time frame participants, whether it's long-term influential time frame participants, whether it's short-term algorithmic participants. It brings a lot of participants into the market. So if we have one or two or three different reference points, we're going to have loads, if not all the different time frame participants participating at that point in the market. And that is why confluence points or a confluence play work particularly well, because there's a lot of different time frame participants all getting involved. So this is the second of our momentum strategies, and let's get into it and we can discuss why. Now, what we spoke about in some of the slides was we spoke about two different types of confluence plays. Now, there exists many different confluence plays. What's important is to understand the concept of confluence. So the two we spoke about was, firstly, the initial example we had was actually a weekly confluence play where we had the E-mini S&Ps on a weekly chart, and we spoke about how almost day one we sat within the previous week's range but formed a double top. And then on day two, we started to see initiation, various different time frames enter the market, and the market started to drift higher with the trend. So that was our first confluence play or confluence initial balance breakout play that we spoke about. And the second one we spoke about was the one we're going to discuss here. Now, just to paint a little bit of context, on the previous day, we just had a mere normal distribution day, and the market formed a low, and we then opened up somewhere in around the middle of that range, and the initial balance initially double bottomed with the previous day's low. So let's get into the strategy now and have a look how it played out over the course of the day. So as you can see, the market opens up and trading well inside the previous day's range. We can see that is now our key pivot. Remember, we spoke, that is our confluence point in the market. So key point there, as we can see, sorry, that's not the confluence point. Down here, 161.70, that is our confluence point. So the M cash print opens up, that's the cash market. Remember what we said is we're looking for stops below that key confluence point. So we're looking for longer term time frame participants to step into the market. Now, as you can see, so the market comes and it breaks that 161.70, trades straight down to 161.35 area. So a nice quick move. Now note, in 30 minutes, what we did. In 30 minutes, we did effectively double the range that we had on the day. So as you can see, quite an aggressive early move. Now, let's just pause this quickly and just assess what actually has occurred. So, first and foremost, we said with the confluence play, or again, note, I'm using the initial balance here as my secondary confluence. The important thing to understand is that confluence can be any number of reference points. Remember, confluence is just where we have multiple reference points. Okay, in the example I'm showing you, I'm leaning on the previous day's low, which is at 161.70, as well as, obviously, the initial balance low. Now, the first thing we spoke about is once we see the confluence in play, we want to then look for momentum type strategies, which in this case is looking for short side trades on the break of that initial balance low. And note how quickly, within 15 to 20 minutes, we very quickly got paid out on that momentum play. So in terms of the characteristics, what we want to look for is the volume plus the volatility. So we want to see volume and volatility expansion, which is exactly what we've seen as the cash market or the M print has opened up. More importantly, because it's a momentum type play, time is a very key element with a strategy, all right? It shouldn't take long for the market to tell you whether or not you're wrong or right. Now note, if this is a key point, if we have referenced this confluence area in the market, as a key point, we should see long time frame participants initiating. Short time, we should see a lot of initiation in and around this 161.70 area, and it's that initiation which has created the downside opportunity, and that is why we're focusing on this play. So the minute you see this play not play out in that manner, the minute you see the market maybe not be as aggressive as it is in this instance, that is the key, guys. That is what you want to pay attention to with regards to this this setup. Now, the second thing to pay attention to is that once we take out that key confluence area that we've spoken about, there are naturally going to be short-term shorts in the market. So there are currently shorts, or the positioning of the market is net short below that 161.70. So that's important to understanding this confluence play, because what we should in theory see with regards to this play is one of two things. Either the market continues once it breaks the key reference point and continues to trend lower over the period of the day, or we come back to that key reference point, take out the natural positioning in the market, and go in the opposite direction. So there's our two plays, guys. First and foremost, we're looking for the short on the break of the reference point, looking for momentum and initiative once we take out the confluence area. However, if we continue to hold that confluence area, the market should continue with the short-term trend. If it does not, that key break becomes a very important area because of the short positioning in this example that we've just seen. Now, let's continue to play this and see how it plays out once above the key confluence point. So, we can see now that, let's change the color here, we can see the market's now come back above that key point. Now note, if this is the area where shorts were shorting below, it's the same area that we should see long initiating longs now. So what we're looking for, once this market comes back above, is we should be looking to initiate longs above that 160, 170. And as we can see with the N print and then the P print and the Q print, we can see the unwind of that short positioning, and we can see how aggressively, again, notice how the pickup in volatility occurs as prices are moving higher. Why? Because we're seeing shorts having to pay up at higher and higher prices. Note, once all those shorts are out the market and the positioning returns to more neutral, we should start to see that market flatten out a little bit and begin to distribute for the remainder of the day. So it's very simple. We're looking for shorts initially on the break of the reference point. If we cannot hold that level, we're looking for an unwind of that positioning as the reference point no longer holds. If we get a retest of that area where the shorts unwound, that should now hold as initial support. Why? Because resistance turns to support. So let's see how this plays out now for the rest of the day. Note, those are the two key sort of trade setups or trade strategies we're looking for in and around that confluence point, and then as well as support and turning to, or resistance turning to support. So that would have been our resistance, that would have been our support. Now note how the market is actually, over the latter end of the day or the latter end of the session, starting to form a little bit of a distribution higher. So what we can see is that very easily that someone very aggressively, whilst we got the initiative very early on, there were some longer time frame participants that really wanted that market, that bought up that market quite quickly and quite aggressively. Again, notice how the V print comes in and around down towards that 161.70. So let's just fast forward this a little bit, see how it plays out at the end of the day, and then we can hopefully wrap up our fourth in our series of strategies. So if we go back there a second, let's see how quickly this market bounces off that key support area where resistance turned to support. So as you can see, we've got an inside candle on the W, the X, then the Y print comes in now, and straight away the Y print comes into that key reference point that we spoke about. So note how not only did we get a good buy opportunity early on the day once the position unwound, but the market then respected and held that new support level. And again, notice the length and the size of the Y print. Notice how it's substantially larger than any other candle on the day. So again, not only did we see aggressive buy side off the low, we then saw a very aggressive buyer a lot higher up on the page. So that concludes then our strategy on the confluence initial balance breakout. The important things to understand and interpret with regards to the setup is, one, what is a key reference point? What makes up a confluence reference point? any point in a market whereby we're likely to see a number or a whole host of reasons that multiple time frame participants will enter the market, that becomes a confluence area. And because by that very nature we have a lot of participants entering at that point, there's going to be some form of positioning. Now, either we continue with the short-term trend with that positioning, or that positioning needs to get unwound. That is the key highlights from the strategy. Now, I hope you guys have really picked up on some of the, the major characteristics that you can see in this confluence initial balance breakout. But most important, guys, remember, confluence initial balance breakout is not just with the initial balance. It could be with a number of different types of reference points, whether it's support and resistance, whether it's trend lines, whether it's Fibonacci's, moving averages, yield levels. It doesn't matter. The important thing to understand is, what are those reference points? Who will be involved once we take out those reference points? That concludes then our strategy 4. Make sure you guys go back and find these strategies. Look for them in the mini S&Ps, look for them in the Eurodollars, in the oil, look for them in any market, because they exist across a whole host of markets. Don't forget, guys, practice makes perfect. We're now going to talk about strategy 5, which is the third of our momentum strategies, and this is the consolidation breakout. So the best way to sort of explain and characterize this trade setup is to show you the 3 types of consolidation you can expect to see before we get the breakout. Now, the important thing and the wonderful thing about consolidation breakouts is you get so much time to prepare for them, and that is a key element in its own. I'm going to create a rule and set a rule from you so early on. Never preempt. Okay? A lot of the time, traders will look at loads of trade strategies and they're preempting, what is likely to occur based on their analysis and bias. And what I will say to you is that, well, sometimes you will be right preempting. There isn't a sufficient amount of, sort of risk reward you can take on by preempting. More importantly, the market can take a lot longer to actually do the breakout than you sometimes think. If you want some examples, just go look at, for instance, the Aussie dollar, or the Japanese yen, or even the euro dollar over the recent years, where we had large fundamentals in the market, and the market spent, maybe 1, 2, or even 3 years within a consolidated range. Now, again, note, consolidation breakouts can occur over 1 day, 2 days, 3 days, a couple of weeks, and even months. The concept and the principle remains the same. Let's look at some of the key characteristics, let's look at some of the key consolidation breakouts I will share with you both here and the replay functionality. So the first is where we have a bracketing market. So the market for a number of days is stuck inside a sideways range. Now, again, these consolidation areas or bracketing can be, sometimes a few days, but even a couple of months and years. So the important thing to understand is what occurs once we finally break on either side. Now, we are going to discuss the breakout aspect of each one of these 3 strategies, but it's imperative you understand that if a market breaks towards one side and shows all the characteristics, it is assumed it should hold that break. If it does not, however, hold that break, we then have the opportunity to look for a very strong, aggressive reversal type play. Now, how that reversal type play would work is, once we re-enter that consolidation range, whatever we have defined it as, we then look for very aggressive reversal type entry, whereby we initiate on the break point looking for a full rotation of the consolidation range. In the 3 examples I'm going to show you, however, we are only going to be dealing with the momentum breakout, as this is our momentum series. Now, that is our first consolidation breakout. The second consolidation breakout is traditionally known as the inside day break. So this is where day 2 sits well within day 1, and then day 3 we get the breakout to the upside or to the downside. Now note again, it's important when you have this inside day trade that you stick with the short-term trend. So in theory, the short-term trend, day 2 or day 3 inside day breakout will be more powerful than if it breaks against the short-term trend. The third of the consolidation breakouts I will show you is where we have the market that is sort of almost ranging or moving or consolidating ahead of maybe a key long-term resistance point or maybe a key long-term sort of trend line. So that's the third type of consolidation breakout play that you can find. Now, the characteristics on any breakout of a consolidation phase are the same. First and foremost, we want initiative. That is key. We've spoken about initiative a number of times, not just in Module 1 and 2, but also in the Momentum series. So we want to see initiative taken, as you can see in this example, once we take out the key consolidation area. Number 2, we want to see volume pickup, and we want to see a very large surge in the volatility. So again, remember, volume and volatility are both relative terms. And then we want to see the very strong control identifiers such as low volume areas. Now, in the example provided, let's have a look at, the preconditions of this consolidation breakout, as well as how we would execute, where we would enter, and our likely targets. Now, as you can see from the chart, we are looking for a break. We've obviously had day 1, day 2 is inside day 1, day 3 is inside day 2, so we can see the range is constricting and the market is preparing itself for the break. Now again, like I said to you, this market could go either way. It could break to the upside, it could break down to the downside. Obviously, if the short-term trend is to the downside, it will likely be more powerful if it breaks to the downside. But that does not mean we preempt. Please trust me on this. If you don't trust me, go and do the back test. Preempting does not give you the additional amount of reward that you are taking on, in the event that it does fail. So you can take this trade on 3 or 4 or 5 times, and you're likely going to get stopped out, and all those losses you would have taken will never justify any kind of potential reward you would get from preempting. Remember, guys, it's all about timing when it comes to developing your strategies and developing the highest probability outcomes, that will make you profitable at the end of the day. So the key is we wait for the break. By waiting for the break, we can manage the most important thing, which is risk. In other words, by the definition, a momentum play has got minimum risk and maximum upside. Now, what we want to talk about is we are entering once we see that initiative. So we can see the market showing some very early initiative. It then takes out, in this example of the oil, it takes out the previous day's low before distributing quite aggressively, as we see the initiative break. Now, the important thing to look at in terms of this is once we see that initiative, we're looking for short side trades only with a stop above the point where the initiative is taken. In terms of target, remember what I said to you, we have maximum upside. Now, in this, when you have these consolidation breaks, there's a general rule of thumb. The bigger the consolidation area and the longer it's taken its time to form. In other words, a consolidation area of 3 days versus one of, say, 6 months. In the example of 3 days, you want to, you want to be looking for a smaller target than in the example of a 6 months. And the reason is simple. When a market has waited this long for a long-term break, we're likely to see much larger influential participants enter the market, which will almost exacerbate the move to some extent. Now, as you can see in this example, after 4 days, we initially got nice aggressive short side opportunity and the market continued to move lower. Now, the important thing to understand is we have a stop in place, but in terms of a target, we need to stay in this trade until such a point that the market tells us that the initiative is no longer there. So long as the market keeps showing initiative as it's moving in our favor, we do not want to get out. If, for example, in this instance, the market came back and started to fill out these areas, we can then look to take some profit and exit this trade, locking in some profit. So again, when you have these initiative moves on the consolidation breakout, we exit not when we feel comfortable, not when the profit is enough, but we exit when some other time frame participants respond to the prices being advertised. Let's have a look now at some of what the other consolidation breakouts would look at and that you can expect to see. So the second in our example is this is obviously the breakdown of the oil again, and just note the initiative. Notice how we saw the initiative and the market came back and gave us almost a picture perfect entry. Now what I will say again as a rule of thumb, remember, and this is something to point out, the market will always reward he who is patient enough to not get over anxious. Now what I mean by that is, what you typically find on these big consolidation breakouts is that because everyone is seeing the same thing, because participants have had a long time to sort of, develop an idea as to how they're going to execute this opportunity, we tend to find people who miss the early move get involved and short in some very bad areas, almost an anxious type entry. And it's this anxiety that ultimately allows the market to come back and give us the picture perfect entry. What I will say, in my experience as a trader, is that more often than not, the market will always give you that one opportunity. But the question is, if you have been over anxious and you've sort of been muddled in your approach and your strategy, you probably won't be able to take advantage of that one golden opportunity. So be patient on entry, and once you do enter, don't give up that position without a very strong fight. Take the risk on the strategy, because remember, we've got minimum risk and we've got maximum upside. Okay, so let's move to another example. This is our second of our consolidation day types. This is the E-mini S&P 500. As you can see again, we have the inside day, so there's our day one. There's our day two with the inside day. And now note the tail. So again, in this example, we had a nice little K tail or a buying tail or a reference buying point. And notice how once the market took out that reference point, we started to see some single prints and initiative as well as a low volume area. The market obviously had its initial move, came all the way back, and what did it give us? It gave us the picture perfect textbook entry. But only if we didn't sit there and execute yeah, and yeah. Again, let's look at our third example of a consolidation breakout. So this is the previous example. So as you can see, we had the initiative and the market pulled back and gave us the opportunity. Equally, we had the initiative and we could have even entered on the X, leaving the low volume area after we made the break of the key level. Let's now move on to our replay series, and let's go have a look at what some typical distribution breakout examples would look like. Welcome to the replay series, and we're back now for strategy number 5, which is the consolidation breakout. So what we're going to do as usual is we're going to go through a few things to point out before we actually do spend some time with the replay function. Now, the important thing to understand with the consolidation breakout is first and foremost a momentum strategy. But you will get various types of consolidation, and the important thing to understand is that consolidation is merely the market, biding its time, or a lot of two-way trade that the market is executing before the next move. So we're waiting for that next trigger, whether that's technical in nature, and we see initiative being taken by either the buyers or sellers, or whether that is just more fundamental information that the buyers and sellers can then interact off. Now, some of the types of consolidation areas we've spoken about in previous slides would be as follows. So the first would be when we have a market that is what we would say coiling. So we would get sort of a daily distribution like that, and then a second day like that, and a third day like that, where we get constant overlap between, not just, where the market perceives fair value to be, but where the market, in terms of trading price, we get this constant overlap, and we're trading within each day's range, day after day after day. So that would be the first type of consolidation we could get. And we saw this example, as we spoke about previously, we saw this example in the oil market not too long ago. Now, the second type of consolidation, which is also known as the inside day, is where we have just merely, that would be our day one, and our day two would then be inside the previous day. Now, again, this is also a form of consolidation. It's not as powerful as the first example, simply because there's not that much energy that's been coiled up, as in the first example, but it is still a very important trade setup and consolidation pattern, as it does bring pretty good opportunities. And then the third type of consolidation is where we have a lot of overlapping trade in and around a key support area. Now, note this doesn't have to necessarily be inside candles or within the previous day's range, but we do need to see a lot of consolidation, either around key resistance or around key support, or even maybe a trend line or some longer run areas that the market's paying attention to. So those are the three types of consolidation that we spoke about. Now, the important thing to understand is that when we have this consolidation, we then need to be prepping ourselves for the breakout. Now, a breakout in essence it's a very patient trade setup, and timing is absolutely crucial to the breakout. So some of the key characteristics to pay attention when we go through this example are the things like, for instance, volume, the volatility, the momentum. So we're just going to write momentum there, and then obviously the low volume areas and single print. So those are some of the key things you want to pay attention to as we go through the example ahead. So let's click the play button and see what happens. Now, the first thing to point out is the context of the previous day. Now, the context of what we were seeing in this market would be, we've effectively had an inside day, so this would be day one. Day two, we had a higher low with a nice buying tail, so a very key little low there. And day three, suddenly we've opened up in and around this point. Now, what we're looking for is we're looking for a break of this tail buying day, but then also two, the lower bound of the day one. So we've got a day one there, day two, and we're currently sitting on day three. Now, the important levels to watch out for, the important areas, is this 2115. This area is that first tail that we had on day two, and then this low here from day one is sitting in and around the 2112 area. So that's the areas we're going to pay attention to as we go through the setup. Now remember, I said to you, the key to this momentum play is not necessarily to identify that we could see a break, okay? Any trader, anyone that looks at charts will be able to tell you that a break is coming, or that the market is about to move up or down. The trick and the art to this trade strategy is to perfect the timing, and that's what I'm going to show you today. I'm going to show you how, one, we've identified the characteristics now. We've said this is what we're looking for to get involved in this trade, but two, we're looking for a very specific form of execution, and that execution is going to come very aggressive. Okay, note it is a momentum play, so we have to be aggressive in entry, and two, we need to be looking for speed and volatility. So that's the key execution parameters we're looking for as we go through this trade setup. So again, as you can see now, we're very easily sitting well within the previous day's range, and let's just fast forward this a little bit further on and get a little bit closer to those key areas of reference. Now, the important thing with these momentum plays is to understand that when a market approaches these key levels, how it responds at those levels is crucial. Okay, we don't particularly want to see we don't particularly want to see the market spending too much time around this area. So let's watch what the market does in and around that first little tail area. So we could see, note how the R print, we've seen a little bit of volatility in that R print, we've seen a much bigger range than other prints, and again, notice what the market does there first time. market bounces off the 2116s, showing a little bit of respect. Let's just pause this for a second and talk about that. So as you can see straight away, we've got a pickup in volatility on the R print. Market opens up a little bit. The S print, okay, again continues the volatility toward the downside. Again, we can see the volume picking up in this situation, but note how the market respects that 2116s first time. It says, you know, the sellers step into that area. They're not ready to commit to the break just yet. Now that's important to understand because, you know, preempting breakouts can be very, very costly. So remember, in terms of execution, yes, we want to be aggressive, but we do not want to be aggressive until the market has made the break. That's important to understand. Once it makes the break, in other words, once we get confirmation on this T print that we close below the 2016s, bang, then we get aggressive to the short side because now the market is confirming that we have actually broken. Let's play on now and see what happens for the rest of the setup. So again, second attempt at it, market comes in, and finally we get the hold below the 2016. So now what we're looking for, now that we've broken below, the very next TPO, so the very next TPO, which is our, let's just rub that out, which is our U print, that is our entry print. Notice how the market comes back and gives us a retest. So it's giving us the opportunity for short side entry trades. Again, note the trade being facilitated lower bound before we then get the continuation. Now, one of the pitfalls, one of the mistakes a lot of traders make is that because they've seen the break, they get very aggressive on the shorts and they start selling in and around this area at the low here. And then if the market bounces, they get shaked out of the position, they get scared out of the position before the market finally eventually continues. So remember, you want to be aggressive in this pattern, but still, price location is important. Be patient. Let the market give you the retest of those 2116s. And then note, once we take out that new low again, notice how the market shows a bit of initiative through the 2116s. We've also now taken up that second level, 2112s, and again, look at the continuation. A nice 6, 7, 8 handle move to the downside. Now, in terms of the close profile, let's just take a look at some of the key identifiers that we can pay attention to. So that was our key area, the 2116, and we spoke about the 2112s. Now, notice how once the market took out that first area and confirmed the break, we then got the market suddenly starting to leave single prints and a low volume traded area and a continuation. So again, the key to managing this setup is to be aggressive, but be aggressive at the right time when the market suggests you be aggressive. So again, that's pretty much the highlight of a consolidation breakout play. It pretty much highlights where you want to be aggressive, how you want to be aggressive, and most importantly, how you want to execute and manage the trade. Now, in terms of targets, remember, sometimes you're not going to get such a straightforward continuation patterns. Sometimes you're going to get a lot of two-way trade, and you're not going to get all these various areas of single prints. Okay? Remember, if the market is showing signs of initiative, showing signs of aggressiveness, then don't get out of the trade. Okay? Don't forget, we get out of a trade when the market tells us to get out of the trade, not when we feel we should get out of the trade. And that example comes here. Notice how quickly that A print made a new low and reversed in the same time frame. There's your example. Buyers have stepped in now on this A print. We can see the buyers are in. So if we short from somewhere higher up here, we're now looking to take profit as buyers have stepped in to the market. And we can see the confirmation of those buyers stepping in, as notice how all of a sudden, ever since we made that A print, the market is now consolidating in the lower bound of the range. So that is pretty much our consolidation breakout. Going forward in terms of the setup, don't forget the key strategies, okay? When obviously we're looking for a break of 16s, we're looking for the break of 12s, waiting for that confirmation, but don't forget, the first time we test that 2012s, you want to be looking for first time shorts. Why? Because that is the point that the market went from, support, and we then turned support into potential resistance. So that concludes our strategy 5 for the consolidation breakout. Remember guys, go and find these plays, go and find these strategies throughout the oil market, the euro dollar, the Bund, whatever market you trade, consolidation breakouts exist. Go and find them, add them to your playbook, add them to your arsenal setups, and remember, practice makes perfect. Welcome then to strategy 6, the final in our momentum series. This is the wide initial balance distribution play. Now, before we move into the actual play and discuss it in terms of the characteristics and its conditions, let's just talk briefly about the concept of control identifiers. Now, we spent a lot of time in Module 2 talking about these control identifiers for a very specific reason. What you may have noticed is that throughout these 4 momentum strategies, we tend to see a lot of these control identifiers. Now, some of those control identifiers are single prints, low volume areas, tails, volatility, where we have range expansion, the one-time framing, and lastly, engulfing TPOs. Now, it's important that you always sort of make a note, as you're trading throughout the day, if you ever see any of these control identifiers. And the reason is that these control identifiers are showing us a shift in the manner in which buyers and sellers are interacting with one another. When you see these control identifiers, it's most likely they are presenting potential trade opportunities. With that in mind, let's now move on to the wide initial balance distribution trade setup. Now, where we begin with this is firstly with the definition of the word wide. What I will say is this is very much a relative term. So what you need to understand about this trade strategy is you need to know what is the average current range of early trade. Now, there's a number of ways in which you can do this. One, I have a tendency to use just a simple moving average of a desired time within each market. So, for instance, in the Bund, I can tell you what the average range is between 7 and 8 a.m. In the E-mini S&Ps, I can tell you what the average range is from 11 p.m. at night till 2:30 p.m. and so forth and so forth. Now, by knowing what the average range is within these time frames, I can see when there is a relatively wide initial range within the market. Now, when I see these initial ranges being particularly wide, there are 2 types of trade strategies that exist. And they look as follows. The first is we have the wide initial range. The market then has a volatile range within that wide initial range for the remainder of the period. So we see the market sort of having an attempt to extend on the aggressive high, failing, rolling over, and attempting to extend along the low, failing, and continuously moving within a very wide volatile range over the period of the day. The second example is where we have a wide initial balance. The market attempts the extension with the direction of the short-term trend, fails, comes back inside, and merely just distributes for the rest of the day within a range. Now, you should straight away notice that in the first example, we tend to get a very volatile range within the entire range, whereas in the second example, we merely just test one's extreme and then range within the top half or bottom half for the remainder of the session. Now, in terms of the trade opportunity, it's important before we show you the trade opportunity to understand why this wide initial balance actually occurs so that you can then understand how you are supposed to take risk on this trade strategy. So the reasons why it does occur can be a number. Firstly, it could be for fundamental reasons. So let's say overnight new fundamental news hits the market and the market opens and moves very aggressively in one direction. It could also be for technical reasons. So the market may open beyond a key technical level, and as a result, we have a lot of stops being initiated on the open. It could also be because there is early initiative taken. So we see long-term time frame participants entering very early in the market to get business done. Now, the important thing to understand in all three of these examples is the reason the market fails to, as it shows initiative early on, but the reason it continues to, or fails to continue with that initiative is simply because of the relative change. Now, as a basic example, let's say, for instance, the oil market opens and gaps up $3 on the overnight session. Now, this relative change could be anything from, say, 4 to 5 to 6% change in early trade. Now, as a result of the very aggressive shift in relative value, this means that it's very difficult to expect further initiative over the period of that day. And more often than not, that is why we tend to distribute, as I'll show you in the trade strategy. So what is the trade strategy? Well, it's simple. As you can see in the example on your right, this is the second of the two. Now, what occurs here is we can see the very wide initial balance early on. Now, note this is roughly 10 handles in the E-mini S&P. On average, at that point, the average wide initial balance, or the average, initial balance was roughly 5 handles. So we had double the average initial balance in the session. Now, as you can see, the market, or the cash session, then opened up. It then attempted the extension lower before then settling into a range for the remainder of the day. So the trade strategy is simple. We are looking at the extreme as our key entry point. The minute the market can no longer sustain the break below that entry point, we are looking to enter buy-side trades for a rotation higher. Now, remember I said to you in these two examples, the one is slightly easier than the other, and the reason is very simple. In this example, which is the harder of the two, whilst we still want to take the buy trade, we can see that the relative reward that we're going to receive for being right is relatively skewed to the risk we're going to have to take. What do I mean? Well, we have to put a stop in below the low, or the lowest point that the market has made. Now, in terms of reward, because this market doesn't fully trade the entire distribution, we don't have as much upside as we would like. So the risk reward is skewed toward a one-to-one type play. Let's have a look at the second example so I can show you when we do have the easier of the two options, why this option gives us far better risk reward opportunity. So in the second example, as you can see, this is the rotation. So in terms of the execution style, once that market re-enters the range, we're then looking for buy-side trades. Now again, note how this market actually ended up stopping us out. So again, this trade strategy did fail in this example before eventually giving us potential upside. So it is important to understand and differentiate between the two different variations of the wide initial balance. In this example, there's a much lower probability of success. However, we do still want to take the trade as the risk reward is there. And we won't know that this has failed until the end of the day. So we cannot assume that the market will do this type of a pattern instead of the full distribution. Now let's take a look at what the more successful, profitable strategy would look like. As you can see in this example, the market has a wide initial balance and a wide initial balance, and the market, ultimately the cash opens, it tests to the downside, and once it fails, the next TPO, being the end print, re-enters the previous or the initial range, and we then rotate all the way to the other side. Again, in this example, note how we would have, say, roughly a 10 price stop, and we would have a target towards the upside anywhere around the top end of the distribution, maybe even an extension, and notice how that would give us potential for a 60-tick target. So this is important to understand because this illustrates why we take the trade regardless of what we think the outcome may be. The risk reward is there when it works. When it doesn't work, we are losing a bit, yes. But when it does work, which occurs more often than not, we are making a success of it. This is then our strategy 6, the wide initial balance. Remember to learn to differentiate between what wide means. Once you've done that, make sure you interpret your execution style, your management style, and then also your expectation style. With this trade, a lot of what this trade is all about is the psychology of the trade. And what tends to occur, because we get this very aggressive wide move initially, market participants tend to be a little bit a little bit too aggressive, or they come in with maybe a fundamental bias in their mind, looking for short side trades only, or looking potentially for long side trades only. And as a result, what tends to occur is they miss the bigger picture, which is that we have a wide initial range. So make sure you manage the sort of emotions that you can expect to see on the day type where you have a wide initial range. That then concludes our momentum strategies. Let's now go and take a look at the replay example of the 10-year German Bund. Welcome back to the replay series for the 6th of our 11 unique trade strategies we're going to discuss, and this is the wide initial balance distribution. Now, before we actually move on to the strategy, let's just discuss first and foremost what we mean by the initial balance. Now, initial balance can also be referred to as the initial period. So it's the period before the cash market, or at least the more influential market moving participants enter the marketplace. Now, if we take the 4 examples of the markets we used, the oil would be between roughly 11 and 2 p.m. The E-mini S&P will be between roughly 11 p.m. and 2:30 p.m. The Euro-dollar FX would be between roughly 11 p.m. and 8 a.m. And then the German Bunds will be between 7 and 8 a.m. Now, as you can see, it's not the initial period or the initial balance shouldn't be an exact definition. It should more be the period during which those influential participants are not there. So it may vary. You might find that for a period of 6 months or a year that the oil tends to see very influential participants start coming in earlier than you expect. Make sure you just adjust according to that. Now, once you've established and understood what we mean by the initial balance or the initial period, we then need to talk about what we mean by the definition of wide. Now, the wide is very much a relative term that we use. Now, what I want you to understand is that the important thing to understand is that if on a day-to-day basis, one of the things I would use for this is a moving average of the daily range. Now, let's take for example that the E-mini S&Ps, currently the average daily range is 10 handles. All of a sudden, you come in, the cash session's about to open, and we find that the overnight initial period is actually maybe 15 handles. Okay, so substantially larger than what the average daily range of the E-mini S&P is. Now, that is something you want to be aware of, because when you see this very relative wide range that's occurred before the cash market is open, you're very likely to see this strategy, which is the wide initial balance distribution play. Now, the key premise of this play and the key thing to understand is that when we have this relatively wide range that's been exhibited before the cash market opens, there's a very high probability the market is going to spend the remainder of the period, or at least the remainder of the period where the influential participants in the market distributing. So in a basic drawing, once we see that very wide range, the market is likely to do one of 3 things. The first and most likely is a full-scale volatile distribution. So what we mean by that is that the market will open and range within that range for most of the day, but it will do it in a volatile manner. And the reason is simple. When we get such a wide range initially, what tends to happen is you tend to get a lot of almost false momentum. So players will be looking to short at lows, looking for continuation, and they then get trapped and need to reverse. Equally, we'll get short-term players trapped into the highs looking for failed momentum, and then they'll need to reverse. And that's what creates almost what looks like momentum, but the momentum is not necessarily in a breakout manner, but rather within a distribution. And that is why we've added this to our series of momentum plays. Now, these plays, that's the first sort of type of example that you'd find, but these momentum plays can be particularly lucrative, but they do require you to first and foremost identify when the strategy is in play. Now, the other two typical patterns you can expect to see is where, again, we have a wide balance, but this time round, however, the market tends to distribute in a much smaller range toward the upside, and in the second example, a much smaller range toward the downside. Now, what we're going to do is we're going to look at the example where we have a volatile distribution throughout the entire day's range. So I can show you guys how quickly the market can move from high to low and low to high, and show you that in this instance, if you identify the strategy early enough, the risk reward is there to fade the failed perceived momentum. So let's go through the play and see what it looks like over the course of the day. So as we can see in this example, just to paint some context, the average daily range was roughly 70 ticks. And as you can see, the market comes in, we trade from 160.60 all the way down to the 159.75. So let's just go back a brief moment and have a look how the market played out from the start. So the market opens up, we very aggressively move down within the first hour of trade. So we know that the initial balance in the Bund is from 7 to 8 a.m. Now, the cash market comes in with the M-print, as we can see, and the M-print straight away, if we pause that, the M-print straight away moves and breaks the initial balance low, and then we get this perceived momentum. So it's almost like, you know, we get a lot of shorts entering short below that 159.90, looking for a continuation of this perceived initiative or this perceived momentum. So straight away we've got some short positioning in the market. Now, again, that's not altogether a bad trade. However, anyone that's taking that short side trade is unaware of actually the context of the market, which is that what we have done within the first hour of the trade, whilst all the influential players are out of the market, is we've actually done the average daily range within the first hour. So straight away, if you can pick up on this and identify it, you will notice there should be some short positioning from short-term participants in the market at that 159.90. So let's play it now and see, as you can see, how quickly the market gets back above that 159.90. So let's replay. We can see the cash opens, cash comes in. We see a little bit of aggression in the cash market. Cash market takes out the initial balance low. Bang, bang, bang. We start to see the market go bid again. So within the same half-hour period, the cash takes out the initial balance low and makes a new low on the day. But most important, where does it close? Bang! Closes back inside the initial balance. And that is our first early clue, the fact that we close back inside the initial balance. Now notice how quickly, once the market closes back inside the initial balance, how quickly we get that end-print scrambling toward the upside. Why? Because firstly, the shorts need to unwind, but more importantly, we're starting to see fresh buyers enter the market. Now notice how in the N and the P print, so within 2 TPOs, we managed to trade almost the entire range of the day. So that's what I was talking about in terms of we get a volatile trading session, a volatile range where the market looks like it's moving very aggressively from one point to another. Now, the key objective and what you need to be looking for in terms of the strategy is very simple. We're looking to buy toward the low sell side and sell towards the upside. This is what the play is all about, guys. If you can manage to do this, you will be effectively taking on some very, very strong risk-reward plays. Now look at it. What's it going to cost you in terms of if we're buying in and around these lows? It's going to cost you a stop out somewhere below that low. So call it 10 to 15 prices. Likewise, if we're selling in and around these highs, what's it going to cost us relative to all of this that we could potentially make? So that's the key of the play. We're looking to see that false momentum. So if we look to this upside now, we want to watch how these S&T prints come into the market. We want to see this false momentum into the upside. And the minute that false momentum disappears, bang, 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 we want to look to hit the market on the short side and trade it back towards the lower end of the distribution. So that's the key, guys. Look for that failed momentum, just like we saw on the downside, just like we saw on the upside, and look to go against that momentum. It's a very brave strategy because it's one of those strategies where you're going up against the majority. You're going up against, you know, what the short-term momentum is. But remember, sometimes the hardest trades are those trades that go up against the obvious. And that is why this hard trade, if we sell up here and we buy up here, that is why these trades give us the reward. That's why they give us the reward. That's the key to the strategy. You need to be brave, you need to be executing against the market, and you need to be initiating trades that sometimes might make you feel a little bit uncomfortable. So in terms of the characteristics, it's very key. We're looking for that wide initial balance. We're looking for the market to show us the false momentum to the upside, to the downside. In terms of execution, we need to be aggressive. The minute we got above that first initial balance low, we have to hit the bid. We have to be aggressive. Why? Because, like I said, the market is volatile once it re-enters. It's volatile once it turns. So you have to hit at the market. You don't want to be passive in this trade setup. In terms of management, well, it's simple. We need to have the belief and the understanding that once we execute, we are getting the desired reward for the risk we're taking on. So in terms of where is the trade wrong? Well, in this case, we're wrong below the low, we're wrong above the high. Until that point, we have to be brave enough to execute. Why? Because the reward is there. So that concludes then our strategy number 6 on the wide initial balance distribution. The important thing to understand is, firstly, what is the initial distribution? What is the initial range or the initial balance? Then, what is wide? Remember, it's a relative term. It differs depending on the market you're trading, depending on the market conditions. If you understand those basic two conditions, all you then have to understand is the belief that you want to be going against the false momentum. That then concludes number 6. Make sure, guys, you go and find the strategy across the various markets. And remember, practice makes perfect. Very briefly, what we spoke about throughout part 10 was we started talking about the idea of routine and completing an early morning trading sheet. And I gave you a whole bunch of ideas as to, the kind of things I would include and incorporate in my early morning trading sheet. Now, the crux of it was that, the reason we utilize this trading sheet is very simple. We want to ensure when we begin trading the markets on the day that we are in an objective mental state. In other words, we don't want to take any form of bias that we may have received from the previous day's information and try and enforce it onto today's markets and potential opportunities. So that's the reason behind why we have an early morning routine. I then went over an example of how I would complete a volume profile template. After that, we then moved on and spoke about the cash hours and the importance behind why we want to pay attention to the cash hours. And we said the most important reason is that it brings along with it new potential business as well as volume and volatility, and lastly, potential flows. So again, what this means for us as traders is effectively opportunity. Now, that is the reason why the cash hours are important and why we focus on them as day traders. We then moved on and we started and began talking about our series of momentum trade strategies, and we spoke about the open drive, where the market opens and it drives in one direction and we tend to hold that momentum and initiative throughout the course of the trading session. We also mentioned how imperative and important the opening price becomes. We then moved on to the initial balance breakout, where we were looking for some form of confluence where, the initial balance range tied up with some other form of a confluence point. And we said how, confluence is nothing more than, having two important reference points lined up together, which thus brings in more participants. We then moved into the consolidation breakout, and we spoke about the various types of consolidation breakouts you can expect, whether that's a number of inside days, whether that's an accumulation of two-way trade ahead of a key break of an important level, or whether that was just a market that had been coiling for a number of periods in a bracketing type formation ready to trend. We then moved on to the last of our, momentum strategies, and we spoke about the wide initial balance distribution. More important, we spoke about the relative word wide being of key importance, whereby we need to determine the range currently relative to what the current average range may be. And as a result, when we see these wide initial balances, we're looking to fade any sort of momentum and looking for potential volatility in the opposite direction. That was where we concluded part 10 of our, of module 3. I hope you enjoyed this, and we'll see you again in part 11. You've successfully completed part 10. I really hope you enjoyed those strategies. Momentum strategies are absolutely wonderful. They can be particularly lucrative when the right conditions are there in the market. So it's so crucial not only that you understand the strategies, but you understand and learn to develop those strategies within the right kind of context. Now that we're done with part 10, we're going to check that you understand the principles that we've dealt with throughout this part. So firstly, answer, why are the cash hours so important within the trading session? Then, why is a pre-open routine so imperative to the success of trading? And lastly, I want you to define momentum strategies in terms of the types of time frame plays you can expect to see, initiative versus responsive price action, time objective, the volume and volatility, and the risk and reward. Remember guys, it's important to understand these various definitions, because if you understand that, you will be able to then add to your momentum playbook various types of momentum based strategies. Good luck. It's time for the playbook again. In this part of the playbook, part 10, I'd like you to find strategies 2, 3, 4 and 5 that we've dealt with in part 10. So, I want you to go into the E-mini S&P, the German Bund 10-year, the WTI NYMEX oil, and the Eurodollar FX, and I want you to find firstly the open drive, the initial balance breakout, the consolidation breakout, and the wide initial balance distribution. Remember, take your time. Understand these strategies one by one. Don't worry about rushing through this. That's not important. What's important is that A, you understand the strategy, B, you understand why you're employing the strategy, and C, you learn how to execute the strategy within the best context.